Bonjour, merci d'être.
Good afternoon. Thank you for joining us for the key interest rates, exceptional. So our topic, choosing between inflation and growth. The topic of this debate may sound a bit delayed, but it's essential in its practical consequences. Inflation is the cost of everyday life. And after shadowing the rest of the campaign, well, growth is employment, activity, boils down to. For the central banks, to talk about the central banks, we'll have Thierry JACQUILLAT talking about their influence. Bertrand JACQUILLAT, that is, as a member of the Cercle des Économistes and expert in finance, who will play the role as coordinator. He will talk about the context of the debate, or set the context of the debate, even though he will mention that this is not a new debate. We'll have three speakers, keynote speakers. Vanessa HOLTZ, Director General of the Bank of America Securities Europe. Vanessa HOLTZ, and she has more than 25 years experience in different banks, and as a financial expert, she spent years in England and came back after the Brexit when her bank decided to set up in Paris its new trading office in Paris. Philippe Mills, since 2013, Director General of the SFIL, the Public Development Bank at the service of local authorities, public hospitals, and major exporters. He also knows the financial system by heart. Former head of in charge of placing the French debt on the markets. He is the key representative of French banks. Karamo KABA is the governor of the Guinean central banks in 2021. He studied the economy since his thesis and has worked with Christian de Boissieu from the Cercle des Économistes. The economists talk a lot about the extent of the powers of the CCE, the CBE, while the Fed has a lot of levers at its disposal that concerns not only tariffs but also employment prices. We'll see where the Guinean bank positions itself with all this. So without further delay, we'll start our panel with Thierry or Bertrand. So Bertrand. My name is Bertrand. You called me Bertrand 10 times. And why do you change my first name? And you've known me for 30 years. So can you hear me? Good afternoon, everybody. So I will make a preliminary presentation before our three speakers take the floor. To my left. And I'll try to cover about 5 different points. The first point I'd like to highlight is, we could say Phillips is dead. Hooray for Phillips. Long live Phillips. For those who have studied economy, you all know who Phillips is. He had invented the idea. It was at the origin of the idea when there was a trade-off to do for a central banker within the scope of its monetary policy. There was a choice to make between inflation and unemployment. So if you want to reduce unemployment rate, you had to accept a high inflation rate. If you didn't want much inflation, you had to accept a higher unemployment rate. And so this is why the American Central Bank has 2 objectives. One is the monetary and financial stability, like for the European Central Bank, the ECB. But on top of this, the Federal Reserve aims at having a high economic growth. And when I talk about my last point, and Mr. Mills will cover this in extent, some would like to add or wish to add to the objectives I've just mentioned for the central banks. They want to add environmental objectives. So inflation and growth. As this couple disappeared, and we have one without the other, conversely, it will be fuel for thought. Second fuel for thought is does the nature of inflation, has it changed? The nature of inflation, has it changed? And so with the globalization and industrial specialization of the countries, it seems that this has strongly contributed to compress underground inflations. And we accuse the Federal Reserve Board, the American Reserve, not to take care of the inflation of goods and services because the world economy took it into account and compressed its inflation. And it only was concerned with the price of financial assets with a trend to favor the stock exchange insofar as there were problems with the public opinion. So the nature of inflation, second point, does deglobalization that will put back on the table, will shed a light on the inflation of goods and services. Will this transform and change the monetary policies of the central banks? The third point is the importance of technology on key interest rates. So the impact, this may seem quite far-fetched or far away, but you probably know by name an American economist called Ken Rogoff, who published a book that was very famous some 10 years ago called "This Time is Different." It was a book that condemned those who thought that the hills that happened to economies in the past could not happen again. And so he was trying to demonstrate that times hadn't changed. But we still have crisis. But Mr. Rogoff has just worked on a data bank on interest rates and inflation rates in Western economy countries, and that dates back to 1361. So we have today more than 700 years of data available on the interest and inflation rates. And what comes out of this, the analysis of this database, is that real long-term interest rates have dropped by 20% per century, or 0.2 points per year. So the trend is to the drop. And this is due to technology. We could give other examples for that. And the fourth point, 1.37%, right? Okay, that was the figure. Is the problem of multi-objectives of central banks. We could add, like Mrs. Lagarde did, the environmental objectives, add this to the monetary policies of central banks. And the last point I would like to address, or just mention at least, is the relationship between the subject of today's session and the topic of all the Rencontres Économiques, and that's bring together both worlds. So this leads to the fact that we would like to coordinate in a better fashion the monetary policies of the Federal Reserve and the ECB. Is that a good idea? I'll let the people in the panel address this, my friends from the panel, to debate over this. Thank you, Bertrand. I'd like to go back on the context of inflation and the causes of inflation we witnessed recently, because there are different causes depending on the country. But what we share in common in terms of causes is that we had COVID, the pandemic, a first inflation wave that had not been predicted. It was planetary, had a very strong impact on the everyday life of consumers and also on the behavior of those same consumers. So we saw a drop in production, a shock of supply chains. We saw the cost of freight multiplied by a fivefold, which was absolutely never been witnessed before. And we saw a rotation of consumption also, i.e. we move towards consumption of production goods, durable goods rather than consumer goods, which is not the case today. What was important in the U.S. is that there was a fiscal stimuli that accelerated demand, that boosted demand. So in the U.S. there was a demand shock, while in Europe there was a shock of the offer. And when there's a demand shock, this means that there are a lot of savings. Everything the U.S. Accumulated in 2021 more than $2 trillion in savings, and there's still about 500 billion left of that. And on its side, Europe accumulated savings, so there's a demand, there are liquidities, because they accumulated more than 1 trillion euros in savings. A second wave dispersed the US and Europe. The war in Ukraine with Russia. Here, there was an inflation due to energy shock. We saw the price of oil products rise up to $120 and gas multiplied by 2. And there were there's a big dependency of Europe on towards energy, and that's the reason there were different causes on the inflation that took place in the U.S. as compared to what happened, the inflation in Europe. Inflation in the U.S. went up to 9%. In Europe, we had a peak at 10%. Europe had a double impact, the impact of the shock of energy and the effect of the bottleneck of offer. While in the U.S., yes, there was a shock of the bottlenecks, but a recovery, a budgetary recovery that relaunched the offer. So what was the reaction of central banks? There was a single reaction in terms of timing. First, we saw the central bank and the Federal Reserve and the Bank of England and the ECB rise their rates, but only as of 2022. The central banks wanted to see if this inflation was transitory, and they waited a little longer than other central banks, especially in emerging countries that had already started raising their rates. And retrospectively, the central banks of emerging countries started to lower their rates before the ECB and the Federal Reserve. So there was a sort of like delayed effect that certainly could have had an impact on the magnitude and resilience of this inflation. And so the role of the central banks, we explained this. What is the lever? Well, it's interest rates. We saw interest rates much higher than in the previous decades. The interest rates, we saw that the Federal Reserve went up to 5.25%. For the euro, it was 4%, and in England, 5.5%. And so these were rates we hadn't seen since the last global financial crisis. And what happened? The global financial crisis. Yeah, we hadn't seen this since. I'm Bank of America, so I need to talk a bit in English. And so the role of these central banks was very important, but what we see is that the market underestimated the amplitude of inflation. And just to give you some contextual information, at the beginning of 2024, the central banks and mainly the Federal Reserve, well, the market had pre-positioned a drop of 170 basic points of the rates. That is 7 different quotes. And in the end, we will have 2 or 1 drop of rates, certainly after the elections in December. You talk about divergences of central banks. Of course, the ECB lowered its rates, but it's not increasing. So why did the central banks, why are central banks adjusting their rates differently? It's because the shocks are different. Cost of energy has dropped. The ECB had managed to lower its rates due to that. Did it have the expected effect? Yes, because inflation has dropped. Yet it's still higher than the goal, because it's at 2.5% in Europe. But did it have an impact on growth? We see, in fact, that the countries and globally, well, the growth is quite resilient, because the global growth is at 3.3%, which means that the labor market, investments, consumption is quite important. We see that the consumption in the United States is at more than 10% compared to the pre-pandemic results. And so this impact on the consumption on services that And so this is the context of inflation. Savings, of course, is very important. It continues to be very high. Savings are very high. And on growth, it's also important to consider different points. I talked about a growth that is quite important. There's a certain resilience, but it depends on the sectors, on geography, on locations. We saw that on the level of employment, there was employment rate that was quite flexible with a higher rotation or turnover in the US, less in Europe, and on sectors, well, due to the interest rates, with the rise of interest rates, we saw sectors like real estate or commercial real estate, very strong impact there, with a lot more work from home and a lot less of office rentals. That is on the real estate sector for individuals, the impact was practically none. So the U.S. banks did not react well to this rise in interest rates for a simple reason. It's the mortgages, the loans that we do for consumption. When you do, for example, a real estate loan, they're at fixed rates for 85%. When we did loans at lower rates, well, it's of no interest to pull out of these loans. And in the U.S., you can't change your loan. That is, if you pay back a loan to take another house, you can't benefit from the same interest rate, which is not the case in Europe. You have variable rates. It's not the case in France, but in most European countries, it's variable rates, and this is done. So this is the context and the impact on growth. I think we'll talk about the balance later. Philippe Mills, thank you. First of all, I'd like to tell you that I'm very pleased to be here, and I see that a lot of people in this round table, so it's an important topic here that we're discussing. So around me I have experts, really top-notch in the sector. I'm sitting next to me, a person who comes from a great international bank, and my neighbor here is a governor of the central bank, so in Guinea. So what am I doing here? I'll talk as a practitioner of the market of rates, because that's my raw material. I'm the head of specialized banks, which deals with rates a lot, and that are influenced by key interest rates, short or long, and this has an impact on my activities. So Vanessa described in a very holistic way what has been happening since the COVID up to today. I'd like to maybe talk about the medium term. There are two questions, in my opinion, with a view to the first remark Bertrand made on the Phillips curve, and that disappeared and reappeared. So the first question, in what inflation regime will we be in the coming years? Before COVID, there was no inflation. I was looking at the figures. The average inflation in the 10 years before COVID was less than 1%. And the average rate was around 1% in the Eurozone. And in fact, since COVID, if we work on averages, again, based on the zone Euro, we're at 4 to 6% average, with a peak at 10%. And today we're going back to the target of 2 in France. The latest is 2.1 in France and 2.5 in Europe. And so will we go back to 2% or under 2 and get closer to the previous inflation regime? I don't believe that will be the case, because beyond the usual impacts of the demand policy and stimulation of demand through budgetary policies to face these shocks, there are several reasons that explain that are more on the offer side than on production side that lead us to believe that we will not recover the regime we had before COVID. The first reason, you read that in the papers every day, is the deglobalization. So the fact that today a certain number of companies prefer to ensure the security of their supply chain rather than the maximum economic efficiency. The second reason that we have an economy in which there are some large enterprises that have quite an exceptional market capacity. They have a capacity to do better prices. And the second reason is a demographic reason. Most of the great countries of the planet today have an active population, and in the years to come that will either stagnate or drop. And as Bertrand said at the beginning, the disappearance of inflation, there was the oncoming of hundreds of millions of Chinese workers, for example, laborers. In the future, it's not going to be the same. It's not the same projection. And the other element is when you have a high public and private debt level, it's not really in favor of a low inflation regime. The last element is the decarbonation of the economy. And I will quote someone here who's much knowledgeable than me, Madame Lagarde, the president of the ECB. She did a speech on the 14th of June at the Dubrovnik Economic Conference, and in her speech, she has a very explicit manner. I recommend that you read this speech, that the geopolitical fragmentation and climate transition were negative offer shocks, at least for quite a long period before different effects take place. So it's probable that we'll still have more inflation. But if we turn to growth with this medium-term objective, if we do one of the classical reasoning for a medium-term growth, three factors: capital, labor, and the global productivity of factors. Capital. If we look at what you need to do in terms of climate transition, you will replace capital, but not to increase production and not to do productivity gains, but take into account that there was a factor that wasn't priced before, that is the greenhouse gas emissions, and more labor, work. Well, that's tied with demographic evolution. If the active population no longer believes, if it drops, there will no longer be a labor factor to activate growth. And for the other one, you have two schools: the techno-optimistics, who say that AI will generate productivity, and those who look at the recent productivity results and say that for the moment we can't see anything on that along those lines. So I will say that there's a non-negligible risk to have yet even more inflation rather than more growth, that what we've observed recently. Thank you, Monsieur KABA. Your point of view, when Monsieur Mills talk about deglobalization, that's a question you can answer later. But I saw in different of your publications that you were sort of like concerned with the consequence of present conflicts on the energy supply paths and networks. But first of all, your idea on our key subject. Thank you. Good afternoon, everybody, and really thank you very much for this invitation to the Rencontres Économiques avec Aix-en-Provence. So before answering your question, let me tell you a short story. Often in Paris, I like to wander around Barbès, Rochechouart, and I often run into this gentleman, and he always asks me the same question: do you like Bouteflika? And so the first time I told him, yes, and he went crazy, you know, just, do I like Bouteflika? Do you like Bouteflika? The president of Algeria. And he went crazy over me, you know, he was really upset. A few weeks later, run into the same gentleman, same question: do you like Bouteflika? And I remember the first time I ran into him, so I said, no. And again, he hollers at me and he goes very upset. And a few weeks later, I made the same guy again. I remember the first and second time, and I say, I don't know. And same thing, goes crazy. just to tell you that when you're a public decision maker, whatever you do, people will go for you. So you have to accept this. So to answer your question, of course you have to do everything you can so that to ensure growth. And when the central bank started to rise the interest rates 2 years ago, everybody and me, as first, we thought there would be a world recession. But the recession, we didn't see it. We didn't see it because there are some states who implemented budgetary stimuli. And so, to illustrate my position, according to the rules of the central banks, if you take the non-financial credit sector, in 2018, we were at 152% of the GDP. We went to the highest level at 159% in 2023, and recently we brought it down to 157%. And so this drop, well, the states implemented budgetary policies. We saw that in France, we saw that in the US and in Japan. And this budgetary situation enabled to cancel, but not entirely, the impact of the monetary situation. It's also something that explains the difference in growth between the Eurozone and the US. Earlier, Mrs. Vanessa was saying that when you take the consumption of households, for example, compared to the fourth quarter of 2019, in the US we're at +10. When you do the same comparison in the Eurozone, we're around -16%, which explains why, according to the IMF, this year there will be a positive result of 0.4% in the US, while in the Eurozone will be at 0.05%. So all this explains why the ECB has lowered on the 6th of June its basic rate since the beginning of the pandemic. And so, since I'm the governor of the central bank in Guinea, well, we had to follow the same. So what we noted is that there was a rise in the loan rates. You must know that in our country there was a spread that exploded. We were around 190 basic points before 2019, and after that we went to, after February 2020, we were at 60 basic points, and now we just lowered at 300. So you see that the credit conditions have been hardened. And what we saw also is that demand for credit on behalf of businesses had dropped, while bankers were giving away less and less credit. So that's why at the Guinean Central Bank we decided to accompany the stimulation of the state budget to so we supported, yes. And as Michel Rocard used to say, you can't decide on growth. You can't decide growth, I'm sorry. As I said, that's why the authorities of Guinea focused on structural reforms. We focused on the local content. That is, as of now, we will focus on local production. And so, as far as inflation, it's something that we should not neglect, because if you leave it aside, the people will remind you of the importance of this, either during the elections, with their ballots, like here, for example, or on the streets with riots, like the Yellow Jackets, for example. We had the Arab Spring, and we had riots in Kenya because they raised the VAT rate. And as Karl Otterpo would say, the president of the Bundesbank, inflation is like toothpaste. Once it came out of you take it out of the tube, it's very difficult to put it back in. And he added that is the reason why you shouldn't press on the tube too much. And for us in Guinea, we have experienced an inflation that was important and quite high, because when developed countries, when there's a recession, and that's what we learned studying economy, the adjustment is done by prices. And when developed countries start subsidizing the demand, well, at the same time you have an offer that drops, well, the adjustment is done by prices, and the prices rose accordingly. And so we took this first wave of inflation. The second wave of inflation we suffered from is the consequences of the war between the US and China. And so no later than on the 16th of May, we found out by President Biden that it would increase by 100% the taxes on Chinese electric vehicles. So what happened is that the Chinese preempted all containers. So if you want to have one container to import goods in our country, the costs have exploded. And so skyrocketed. So in the coming months, I think the inflation rate will go up again. We have something also in the US. When you look at the CPI, shelters represent 30%. The shelters are the rents that owners would pay if they were the renters. And so the rise is about 7% per year. If you take 30% times 7%, that is, if real estate prices remain at the present level, we're already at 2.1% of inflation rate that is guaranteed for the months to come in the US. And so, as Mr. Philippe said, I don't see inflation dropping under the targets of the central bank. So we will stay at high levels, even if it's lower than it was in the previous months. So I'll stop here. I think I have no time left. Thank you.
So, all four of you, if you have heard properly, you said that inflation is difficult to get back into the toothpaste tube, and what are the conclusions we draw from this, from the point of view of political action? I'd like to say very quickly, I think we have more or less the same conclusions. To be able to find a situation of balance, the level of the balance won't be the same as pre-COVID. We'll see, we'll have to look at the deficits. When you look at the level of the deficits in the US, which are at more or less 6%, which is huge, 6% of growth. In Europe it's about 4%. And we have interest rates which are quite high. The debt servicing, in other words, the proportion of the debt to be refunded will have to be quite fundamental if we look at the risks and the high interest rates. And I can't see the interest rates going down, or inflation going down to pre-COVID levels. So I think on that point we all agree. The fundamental point will be the budgetary policies, and in all of the economies, all economies need to try to reduce these deficits. You mentioned the debt in relation to GDP. If we look at the debt in different geographical areas, for example in the US, which is above 120%, it was at 65% about 10 years ago. Except that these levels of debt, the cost of refunding the debt with low interest rates is quite low. And if you have these debts which have increased and have more than doubled in the US, and the same thing in Europe, and in France too, where there's a big deficit, we know perfectly well that this means that debt servicing, the capacity to refund these debts, will be very difficult to put in place. So all the central banks have to take account all of these factors. We say that the mandate of the World Bank and the stability of prices and of the Federal Reserve is employment and growth. And I believe indeed that the central banks will have to work with the politicians to go beyond this and to favor growth. And this goes hand in hand with the ecological transition and the digital economy and the technological innovation as well. So, if I continue talking about my view as looking in the medium term, the last question that Bertrand asked, I was very struck when the ECB redefined its monetary policy 3 or 4 years ago, where it signed that the target for inflation in the medium term was 2%. You may remember at the same time it also published a communiqué indicating how it was planning to take account of all of the effects of these policies on climate transition. And in particular, it asked the banks, and we are one of the banks that are supervised the ECB, were asked to analyze their balance sheets and as a function of this risk, and to determine whether it needed to change its securities purchasing policy to favor green bonds more. For me, my question in this respect is quite simple. Vanessa has just said quite rightly that public debt and deficits and the OECD are at a high level. So at one time or another, probably we will have to bring them down. In addition, there are priorities that need to be defined, and other priorities in addition to the climate transition. There are two which I think I find quite obvious for the OECD countries, which is, first of all, education and the way we invest in education and the quality of education and training of our future generations. And then there is defense, because in this increasingly fragmented world in geopolitical terms, it's become a more dangerous world than before. I don't need to explain to you why this is the case. So there are other priorities as well, in addition to climate transition relating to deficit and public debt. The support of the climate transition is not the only priority. So concerning the climate transition, excellent reports have defined this. The most recent was from Jean Pisani and Mamafous, which is the first report to be published in French, which really described the macroeconomic path for the next 10 years to ensure we comply with the decarbonization curve. This decarbonization curve, first of all and foremost, results in a negative supply shock with less growth, and also it is characterized by a very high investment wall, first of all from the public sector point of view and from the private sector point of view. And so those who want to invest in this area must be able to do this in conditions which allow them to do so. And from that point of view, this isn't directly linked to the debate we're having at the moment, but it is indirectly linked. The long real interest rates that they have to manage have to be rates that they can manage, that are acceptable to them. And I think for this to happen, and I think the bankers have not yet decided how to do this, but I think the key interest rates have a key impact on these changes, although, of course, not the only factor that's having an impact on these. So I think it's very important for this to be taken into account when we're talking about the evolution of this trajectory. In Europe, there's another dimension, which was described in another recent report by Christian Wayer, which says that the Eurozone is structurally in surplus in terms of savings. We have a lot of money to invest because of this savings surplus. But today, I'm exaggerating a little bit, but this is more used to buy American bonds instead of funding investment, in particular in the climate transition in all of the European countries. And so we have to take measures in terms of the regulations and in terms of our policies to push this use of savings more towards climate transition instead of spending it on US bonds. And this should be the #1 objective of public policy. In our organization, we're certainly, that's our aim. We want to fund sustainable debt. In my turn, I don't think that the interest rates, at least in the US and in the Eurozone, are going to drop in the next few months. Why is that? Because the drop in interest rates we had in June 2016 from the ECB, you have to read the comment given by Madame Lagarde. She said that this would be data dependent. However, when you look at inflation, we went from 11% to 2.6% in May. When you look in detail, you see that the inflation in services accelerated. We see that basic inflation increased up to 3%. That is because wages, the negotiated wages, have risen considerably. 4.1% over 1 year. This is also due to the fact that in the employment market, we are at the lowest level for the last 25 years, and this is the case for France too. So, for the central banks to change the way they approach interest rates over the next few months, we have to have a change in the employment situation, and this is the same in the US. When you look at the Fed, as I was saying earlier, today it has a positive tax gap of 4.8%. There's no interest in changing the interest rates, so the employment market has to show signals of deterioration before the Fed starts to lower interest rates. We're starting to see this already. We're starting to see, in terms of retail sales, the figures haven't been very good. We've seen economic surpluses, which are not very good in the US because real estate, the market is slowing down very much. The prices are still high for the moment. We're at 7% on the Cash-Schiller. When you look at the housing stock, you can see that it's continuing to increase. In other words, households have already taken account of a future drop in the real estate prices. So the households are going to be consuming less over the next few years. That's what they're planning for. This has been reflected over the last few months because the GDP has been taken down. It was at 1.8%, and we've gone now down to 1.5%. And when you look at the essential component of this drop, it is because of consumption. And until we have a stronger deterioration in employment and consumption, quite frankly, I don't see a situation where the central banks are going to lower interest rates as quickly as we would like. Thank you very much. Thank you very much. As we still have some time left, if you have any questions. Somebody's raising their hand there, I think. What do you think of our economic system integration of cryptocurrencies such as Bitcoin into the amount capped at 21 million to cap inflation? So we said the questions had to be easy. I don't think this gentleman has got the message. So in terms of cryptocurrencies, quite honestly, certainly for Guinea, it has no impact at all. For me, cryptocurrencies, I see these as shares, as I don't really see any impact. I don't know whether you have any opinion on this. For me, the impact is virtually zero. Okay, that's your answer. Another question? Could you explain the savings you were telling us about, the financial savings and private savings, households, institutions? Could you explain that a little more? So the savings we're talking about they are financial savings, and essentially in Europe these are the households, it's household savings, who hold these savings. And as Vanessa said, talking about the US, but it's the same in Europe as well, the level of the savings rate in Europe is higher, several points higher than it was before the COVID crisis. I think the most recent figures that Eurostat published stood at about 15% savings rate of European households. Europe, as for Europe and the Eurozone, these are rich countries, and they're aging countries. They have aging countries with the major public pension systems, and we observe that there are a high level of savings, even at quite for the older savers. They hold a high level of savings. Then you have other countries in the Eurozone which have a trade surplus, and so in addition to this high level of household savings, which may be in other areas also, it can be companies that have English savings. There are companies with the trade surplus. They can also have a surplus in terms of savings. So there's a stock of savings in the Eurozone, which again, if I'm not mistaken, before the COVID crisis, it was at between 2 or 3 GDP points, and today it's come back up to that level again. So it's very significant. And the difficulty is not a lack of savings, it's how the savings are invested. It's the way that the savings, since in the Eurozone there is no unified capital market, from the point of view of the legal rules to bring together the different national markets, these savings therefore are sent to other developed countries. And this isn't necessarily the best way of investing when there's a huge amount of investment that needs to be put into the relevant economic area. I'd just like to add something. You said, Philippe, that the pre-COVID rate of saving was 13%. I think it's 19% now. So it's got much higher. We need to see these savings converted into consumption, but we need to put in place our products that are the right ones to finance the climate transition, and also, above all, as you said, we need to have financial products for savings, which mean the money stays in Europe, because at the moment most of these savings go out of Europe. So this is why the idea of a capital market union that France and Germany and other countries in Europe are very much focused on, because it's absolutely vital for these savings, which are huge levels of savings. It's very important for these savings to contribute to investment in growth and development in Europe, which at the moment these savings are benefiting non-European countries. So we have a very high level of savings. We need to have a greater level of certainty. The uncertainty has caused this level of savings to rise, and also the COVID crisis as well. Now we need to see these savings being converted, and this is the only way. There is enough money, there are enough savings to finance the transition for the climate and the environment. We need to have the tools, the right financial tools, and the right projects to ensure that these savings are assigned to the right ecological projects. I'd like to react to that. I agree absolutely with Vanessa in this area of the climate transition. At my level, as a General Director of the French Public Bank, I have lots of European colleagues who are in similar positions to mine, who have come to the same conclusions about the climate transition. The problem isn't the lack of funding. The savings, as they are managed in Europe and more generally worldwide, there is an increasing interest in investing in this kind of project, this climate transition project. So I believe in the bank that I have the honor of chairing, and in the banks who are colleagues and friends in Europe, the problem isn't the lack of funding, it's a lack of projects. And when you're talking about lack of projects, I'm also thinking of everything to different types of uncertainty, particularly about the level of inflation. So remember this message. The problem isn't the lack of funding, it's the lack of projects. So very quickly, I absolutely agree with what Philippe has just said. I would prefer to talk about a saving surplus. This is what we have. This has further increased because of the crisis. If you look at the savings of a country, these are savings from private individuals, plus the savings made by the governments and the states. So the savings are the income minus the consumption minus taxes. So the state savings are the taxes minus the government expenditure. So during the COVID crisis, what happened was that the income rose considerably. If you look at the people who work in a McDonald's in New York, they were earning more money from staying at home than going to work. So when we started to open up the economies again, to get people to work, you had to offer them higher salaries. So the salaries have increased considerably, and at the same time, consumption has not followed that trend. So this savings surplus is there, and it has to be consumed and has to be used appropriately. Yes, I'd just like to conclude this roundtable with two thoughts. Two thoughts connected to what I heard this morning in the first two roundtables in Amphitheatre 1. The first one concerns the interest rates and the changes in the inflation rate. There was a second roundtable this morning called "To have peace, you have to prepare for war," with Florence Parly and a general from Saint-Quentin. We realized that, as Mr. Mills has just said, if you want to have at the same time the budget for the climate transition, and in addition to that, he also mentioned, very slightly saying, you can see what I mean, but it's very important in the roundtable this morning. You're talking about the military and industrial effort. It's very important. A huge effort has to be made to be able to monitor the geopolitical situation. This is a considerable effort has to be made in Europe. This isn't going to bring down inflation or the interest rates. The second thought is the one I heard during this roundtable, which is that there is a lot of savings in Europe. These savings are being invested outside Europe, and we are in our first roundtable with Enrico Letal, who previously president of the Italian Central Bank, who has just published a report on the barriers to competitiveness in Europe, and who was saying that the most important and urgent matter to be able to achieve the objectives that Europe has given itself is to have a unified capital market, so that these savings, which are in surplus, remain in Europe. Thank you.